Welcome back. We are now in segment 6.5, and in this segment we'll be discussing about term liabilities. Please recall our earlier discussions where we have discussed a few terms under the liability section. Please see the big picture. Where are we exactly right now? Where are we? We are discussing balance sheet. In chapter 5 we have discussed P&L, right? In this chapter we are discussing balance sheet. So we are discussing balance sheet, and we've seen that under balance sheet we have liabilities and assets. We are right now under liabilities. So where are we? We are discussing the individual items under liability. So far we have discussed two items, that is capital and reserves and surplus, right? These are the two items we have discussed, right? We also discussed that the items under liability set can be broadly classified under three heads, right? One is the owner's funds, right? And then we have term liabilities, and then we have the current liabilities. So the items can be many under the liability. Say for example you have some 30 items, but then all of these items will be ultimately classified under one of these three major heads. That is, either each of these 30 items will either go to the owner's funds, or to the term liabilities, or to the current liabilities. So far we have discussed the owner's funds portion, and under that we have discussed two items, that is capital and reserves and surplus. In this segment we will start discussing the next major heading, that is the term liabilities. In this term liabilities, we'll be discussing various items that you might come across while analyzing any balance sheet, right? Not that every balance sheet will contain all these items which we are going to discuss under term liabilities, but we will see a variety of items, all possible entries, all possible items that you can ever come across any balance sheet under term liabilities, right? So this is keep this big picture in mind. We're right now discussing the balance sheet, under which we are in the liabilities section. And another liabilities, we have three major classifications, that is the owner's funds, term liabilities, and current liabilities. We are right now in term liabilities, right? So before going into the discussion of individual items under the balance sheet, let us understand what a term liability is. So we have already discussed what liability is. Liability is a source of fund, right? So under the balance sheet, liability is a source of fund. These are the people from whom the company has borrowed funds, and therefore it has to repay. What is a liability? Liability is an obligation to repay, right? It's an obligation to repay. So the company has borrowed funds from these people which appear under the liabilities head, and the company has to repay them one day. So when it is going to repay? So that is the question. So it can the persons who have lent, right, the lenders have given some time to the company. So that when the company has borrowed say 10 lakhs from say a bank, right, or from an individual person called X. So from various persons the company has borrowed some funds. So the bank has lent 10 lakhs there, right? An individual called X, who's a high net worth individual, maybe has lent some 5 lakhs. So various persons have lent funds to the company. So what is the repayment that they have stipulated? For example, the bank might say that please repay this back in 3 years. It has stipulated a repayment schedule of 3 years, whereas this person X says repay in 1 year. Some other person may say repay in 6 months. So what is the repayment structure, right, stipulated by the lender? So when is the funds which the company has obtained has to be repaid? So that will be the basis for the classification of the liability, whether it is a term liability, right, a term liability, or a current liability, right? So a liability, right, can be either a term liability or a current liability. So what is the basis for the classification? So if the repayment, right, if the repayment falls due, right, falls due within the next 1 year, right, this is the basis, this is the cutoff, right? The cutoff is 1 year. Then the liability, the corresponding liability which we are classifying will be treated as if it is within the next 1 year, it will be treated as a current liability. So please see this. So we have obtained funds from a particular company. We have obtained funds from a particular individual called X. So the person has given us a loan of 5 lakhs. So today, let us say the company has borrowed as on, let us say on the 1st of September 2013, the company has borrowed 5 lakhs from an individual called X. Now the person X has stipulated, you have to repay me these funds by say March 2014. So he has given a time of 6 months, right? He says he has to repay in 6 months. He's not stipulating any monthly installments. He's saying repay me in bulk, right? This 5 lakhs you repay me as it is without any interest. Let's not talk about interest. So repay me this 5 lakhs as it is at the end of 6 months. That is as on March 1st in one go, right? No need to worry about individual installments within this 6 months period, right? So on 1st March you repay me the entire 5 lakhs. So if you see the when, see, as per the definition, what we are saying, when the within the next 1 year, when the repayment is falling due. So here the repayment is falling due within 6 months, right? The repayment is falling due within 6 months. So this will be a current liability, right? So if the repayment falls due, the repayment falls due within the next 1 year, we'll be treating it as a current liability, or it will be a term liability. So when we speak of analyzing balance sheets, so what we are given is actually a balance sheet, and balance sheet is drawn as on a particular, that is usually that is the 31st March of some year, right? That is assume 13. So when you are given a balance sheet as on 31/3/2013, and we have various liabilities here, right? We have owners funds, term liabilities, various items, right? Liabilities. So what you have to see is, as on this cutoff date 31/3/2014, right? So our cutoff date is 1 year from 31/3/2013. So our cutoff is plus 1 year, right? So 1 year from this date, from the balance sheet date, that is 31/3/2014. So if any item, right, if any of this item, the liability, falls due within 31/3/2014, if I had to repay the loan before 31/3/2014, any date, it could be February 2014, it could be Jan 2014, or September 2013, any period within the next 12 months, then we'll be classifying as a current liability. If not, it will be a term liability. Is this point clear? So we have a balance sheet here, and under this we have liabilities and assets. So under liabilities, let us assume some, here we have the all owners funds, right? The owners funds. Let us concentrate on some outside liabilities. So within the outside liabilities, we have a bank loan, right? We have a bank loan of 50 lakhs, right? Then we have a chit borrowing. We have borrowed some funds from the chit fund company. This is some 10 lakhs, right? Some amount is due to the raw material supplier, right? Some amount is due to the raw material supplier. This is say some 15 lakhs, right? This is what is known as creditors, which we'll discuss later, right? In a subsequent segment we'll discuss about creditors. So some amount is to be paid to the raw material supplier also, that is 15 lakhs. So, and we have some borrowing some individual called Z, who has lent us some 20 lakhs, right? So these are the liabilities. If you see the due date, we are speaking of the balance sheet as on, let us say the balance sheet as on 31/3/2013. So if you see the repayment terms of individual items appearing here. So this bank loan of 50 lakhs is a term loan, and the bank has stipulated a repayment schedule of, let us say, 5 years, right? The bank has stipulated repayment of 5 years, and it is saying it's a quarterly installment. So installment can be monthly, quarterly, half yearly, annual, right? So bank has stipulated some quarterly installments, which means totally 20, the number of installments total 20. So per installment it's going to be 2.5 lakhs, right? So what the bank is saying is, pay 2.5 lakhs for the next 20 months, right? So this will be 50 lakhs. So for every quarter the company has to repay 2.5 lakhs. So the outstanding will go on decreasing, and ultimately it will come to 0. Of course the company has also to pay interest every quarter, every month, but we are at the moment we are not considering. Let us not complicate things, let us keep things simple. We are not considering interest right now. We are taking only the repayment of the installment portion. So the installment portion, every quarter the company has to repay 2.5 lakhs, and let us assume that the repayment is going to start right away, that is 1/4/2013, right? So 1/4/2013 the repayment starts, and for the next 20 quarters, right, 5 years, somewhere in 2018, 5 years repayment, right? So this being the scenario for the bank loan. The chit fund borrowing, let us assume that the chit fund has a stipulated repayment of say 2 years, right? This is 2 years. Let us say the raw material supplier we have to pay by 60 days. This is the credit period which the raw material supplier has given us. And Z, an individual, right, he has given a repayment of say 9 months, right? So this being the scenario. So we have defined the classification. The classification, whether it's a current liability or a term liability, depends on the whether the funds, the repayment is going to fall due within the next 12 months. So as on the balance sheet date, as on 31/3/2013, 1 year cutoff will be 31/3/2014. So we have to check whether each of these items are falling due as on this 31/3/2014. If you see the bank loan of 50 lakhs, right? Bank loan is given for a tenure of 5 lakhs. So you might be tempted to say, since the repayment is more than 1 year, let us classify it as a term liability, right? But it is not exactly term liability. The reason being, the repayment is split into 5 years, right? So 4 quarters per year. So 20 quarters, 4 quarters per year. So in the first year, every quarter the company has to repay 2.5 lakhs, which means in 1 year, that is 4 quarters, the company has to repay 10 lakhs, right? So 10, 10, 10, 10, 10, 50 lakhs. The loan will be closed at the end of 5 years. So if you see the repayment in each year, that will be 10 lakhs. So each year the company has to repay 10 lakhs, right? So when we're speaking of 31/3/2013, the balance sheet date, right? By the next balance sheet date, that is 31/3/2014, the company has to repay, right? The company has to repay the first year installment, that is 10 lakhs. And the remaining 4 years that are repayable after 31/3/2014, that is beyond 1 year. So out of this 50 lakhs repayment, right? Out of the 50 lakhs repayment, 10 lakhs is due within 1 year, whereas 40 lakhs is beyond 1 year. So if you see our definition, the basis for classification whether a liability is a term liability or current liability is when the repayment is falling due. Here we have both. One, a portion is falling due within 1 year, and a portion is falling beyond falling due for repayment beyond 1 year. So what we have to do? We have to classify 10 lakhs here. We have to see here. We have to classify here 10 lakhs as a current liability, and 40 lakhs will be a term liability. Is this clear? So in the next example, chit fund borrowings. Here we are not given the repayment schedule. So let us assume that it is a bulk repayment. We'll assume that the chit fund company has lent 10 lakhs to the company, and it is stipulated that at the end of the 2 years it has to repay at one go without any installments, right? So this in this case this will be a term liability. Why term liability? Because the repayment will be falling due only on 31/3/2015, right? Here the repayment is 31/3/2015, 2 years from now. Therefore there is a term liability. Raw material suppliers is giving only period of 60 days, that is 2 months. So by May 2013, the company has to repay the 15 lakhs due to the raw material suppliers. This is a very short period, right? Less than 1 year. So this will be a current liability. The company has also borrowed some funds from an individual call set, and he has stipulated a repayment of 9 months. No individual breakup, like no installments. This 20 lakhs is repayable in one bullet payment at the end of 9 months. So this will be 31 December. The due will be 31 December 2013. So this is again less than 1 year. So this will be a current liability. So this will be again a current liability. So you got the concept. So when you see an item in the balance sheet, to classify it whether it is a term liability or a current liability, you have to see whether the repayment is falling due within the next 1 year or not, right? If the repayment is falling due within the next 1 year, it's going to be a current liability. Else it is going to be a term liability, right? So a term liability is a liability which need not be repaid in the next 1 year. This is not going to mature within the next 1 year, so that will be a term liability. So we are discussing various items under term liabilities, right? We have also discussed 2 other items in this chapter so far. So if you see the big picture, under the liabilities we have discussed some owners funds. We are now discussing term liabilities, and then we are going to discuss current liabilities. So under owners funds we have 2 items. We discuss what are those items. One is the capital, and other is the reserves and surplus. Please see that term liabilities and current liabilities, anyway the classification is clear. We are saying term liabilities are liabilities that are going to fall due within the which are not going to fall due within the next 1 year. So they are the term liabilities, and current liabilities are liabilities which are due within the next 1 year. So this classification is clear. What about owners funds? What do you think are owners funds? So from the business point of view, we discussed that the company has borrowed funds from the owner. So when should the company repay the funds back to the owner, right? We have discussed something called the business entity concept. Under the business entity concept, the owner is also just like any other borrower, any other lender. So just like the bank has lent some funds to the company, the owner has also lent some funds to the company. That we gave a special name called capital. But irrespective of what name we give, it is a borrowing from a person called owner, just like borrowing from a bank, borrowing from a creditor, right? So when should the company repay this owner? So we discussed a concept called residual claim, right? What we said was, when the company winds up, what is residual claim? So when the company winds up, see, the company has realized some 100 lakhs by selling all its assets. The company has realized an amount of 100 lakhs by selling all the assets. Now here has to settle the dues of various lenders. So let us assume that the owners have 40 lakhs capital, bank has lent some 50 lakhs, and all other outside parties like creditors and all 10 lakhs. So 40, 50, 10. This is 100. So what the company should do after releasing 100 lakhs is going to settle first bank and creditors. These are the outside parties. So 60 will be first settled, and the balance will go to the owner. So always remember that the owner will be the last person to get the funds from the company. So this happens only in the case of when the company winds up. The owner will not get back his funds till the company winds up. He'll be the last person. It's a residual claim. He'll be the last person to get the funds back from the company. So this is also in a way a term liability, but you can actually say it's a perpetual liability, right? This is it's not a term liability. Term liability means it has got some finite. It's a finite period, like some 5 years or 7 years. We're speaking of term liability, like a bank loan, right? It's got some period. Term liability, the owner's funds is also a term liability in the sense that it need not be repaid within 1 year. So in a way, it is a term liability, but it is something more than term liability, right? It is perpetual. The company need not pay back the owner, right? Only when the company gets wind up, only when the company winds up, only then the owner, the repayment to the owner comes to the picture, and that too it's a residual claim. Owner will not get his entire funds. Only if there is money left he'll be getting. Otherwise he won't be getting anything, right? So if you want to select only whether it's a term liability or current liability, you can select it as a term liability because it is not current liability, because there is no question of repaying within 1 year. So if the option is only term loan and current, if the option is only to select between term loan and term liability and current liability, is definitely a term liability. But actually it is something more than a term liability. Is actually a perpetual liability, right? It runs into many years till the company gets wind up, maybe 10 years, 20 years, 50 years, right? Until the company gets winded up, repayment to the owner doesn't come to the picture, right? So we can classify it as in a way, it's a term liability. So when we come to the term loans from bank, when you see a balance sheet and you have under liabilities, you see an item called term loans from banks, right? Usually this is not the term you see. Usually you see a term called secured loans, right? It's nothing but loans which are backed by security. So usually bank loans will be backed by some security. I'm not speaking of collateral security. It is primary security. So when you give a term loan for say a car, the car becomes a primary security, right? If you given for the purchase of machinery, the machine will be a primary security. Building, if the loan is for construction of building will be the primary security. Primary security is, right, for what purpose you have lent the funds, and the asset created out of that loan, right? The asset created out of bank loan, that will be the primary security. So there will always be primary security. You don't give funds just for nothing, right? You give funds for a purpose. So primary security will always be there. Collateral security is different. You might take or you might not take based on the risk perception, but primary security will always be there. So when you see a term called secured loans, this is the term you usually see, right? Sometimes you also see term loans from banks, right? But usually this is a common practice. Secured loans is something. Secured loans is nothing but it is borrowing backed by some security, and usually these are loans from banks, right? So term loans are sanctioned for various tenures. If you are working in a bank, you are aware of this. You have seen some vehicle loans, right? For individuals, vehicle loans, car loans, right? Gold loans, right? Various loans you have seen for individuals. So each one will be having some period. So repayment in 3 years or 5 years, 10 years. So there will be some repayment schedule. So for a company also, the bank can extend various loans, right? Loans for purchasing of machinery or for construction of buildings, right? So various other loans. So when the bank stipulates a repayment tenure, right, like 3 years or 5 years or 7 years, it's a period greater than 1 year, right? So these are long-term liabilities. But you should also note that, as we discussed, that the bank stipulates something known as installments. It's not like a bullet repayment. If the tenure is 5 years and the loan is 10 lakhs, banks will not say you come after 5 years and pay the 10 lakhs at one go. That's not what banks says. Banks says you repay this over a period of time. So they might say every month. So if it is monthly, it will be 60 installments. So 60 installments, 10 lakhs by 60. Whatever is the amount, you pay every month. Or they can stipulate some quarterly. If it is quarterly, 5 into 4, 20 quarters. So some repayment they will stipulate. So you have to understand that out of the term loan outstanding, some portion will be due within 1 year, right? Some installments, right? And some installments will be due beyond 1 year. This portion, we discussed that we have to take it as a current liability, and this portion will be going to take a term liability. This is already discussed. But you have to note that the breakup is usually not given in the balance sheet. How much amount is due within 1 year, how much due is after 1 year is usually not given in the balance sheet. Some auditors do present it. Actually, it is a very good practice to present, but usually you will not be given this breakup. But as a banker, you know, right? Because you are the person who has sanctioned the loan. You have the file with you. You know the sanction terms. You have the CBS system in front of you. So you know. So even though the breakup is not furnished by the company, you can always have access to that information. So taking that information, you are going to split the total outstanding into current liability and term liability, right? So regarding the treatment, whether it's a current liability or term liability, you have to note that some banks who treat that entire term loan outstanding as term liability. So when you have a term loan outstanding of 50 lakhs, of which 10 lakhs is due within the next 1 year. So 40 lakhs is due in the beyond 1 year. So we spoke that, we already discussed that this is going to be a current liability, this is going to be a term liability. But some banks take the entire 50 lakhs as term liabilities. This is actually a benefit to the company, because we didn't discuss current ratio still, but you will see that by taking this entire term loan outstanding as a term liability is going to benefit companies in the sense that current ratio will improve. So we are going to discuss current ratio when we get there, but you please understand that the classification varies from bank to bank. So some banks, usually the correct practice is split the outstanding into some portion current liability, some portion term liability based on the repayment. How much portion is due within 1 year, how much portion is due beyond 1 year. But some banks treat the entire term loan outstanding as term liability. That is something you have to remember, and it is something which benefits the customers because current ratio will. Let us see what happens if there is overdue, right? What happens if there is overdue? Take for example, so let us assume that the term loan outstanding as on 31/3/2013, as on the 31/3/2013, the balance sheet date, the outstanding is 100 lakhs, the term loan outstanding, right? So this loan was sanctioned somewhere way back in 2011 or somewhere way back, and the company has been repaying installments, and slowly the outstanding has come down to 100 lakhs, right? Let us assume this loan amount was something 150 lakhs. So the sanctioned amount could be something different, but the company has been repaying, and so slowly the outstanding has come back to 100 lakhs. The outstanding as on 31/3/2013 is 100. Let us assume that this is the actual outstanding, right? This is the actual outstanding. But let us assume that as per the repayment schedule, the outstanding should have been, right? This is the outstanding that should have been. This is 90 lakhs, right? What we are saying is, we are assuming a repayment schedule like this. Repayment schedule stipulated by the bank is like this. 31/3/2012, right? The outstanding was 130 lakhs, and this is with zero overdues. So as on 31/3/2012, the company's outstanding term loan outstanding was 130 lakhs with no overdues. So this is up to date. The loan account is up to date. So the repayment schedule is quarterly repayment, and every month the repayment schedule, the installment amount stipulated is 10 lakhs. So if you see the actual, if the company was prompt in repaying the installments, as on 30th June 2012, the outstanding should have been 120 lakhs because the company repays 10 lakhs out of 130. So the outstanding will come down to 120. Then in September, another installment will fall due. Then it will be coming to 110 lakhs, right? In December, another installment will be due. The outstanding will come down to 100 lakhs. And finally, in March 2013, another 10 lakhs will be due. So the outstanding will come to 90 lakhs. This is what I mean by the outstanding should have been 90 lakhs. So if the company were prompt in repaying the installments, the outstanding should have been, as the repayment should have been like this, as per the schedule, and the repayment should have been, the outstanding should have been 90 lakhs. But actually the outstanding is 100 lakhs. So the company is somewhere has made a delay. Company has skipped one installment. Maybe this last installment, the March installment, it didn't yet pay. As on the balance sheet day, the company is yet to pay this last installment. So there is an overdue. So while the outstanding should have been 90 lakhs as per the sanction terms, it is actually 100 lakhs. Thereby, there is an overdue of 10 lakhs. Is this point clear? Overdue means the outstanding is more than what the actual outstanding should be. This outstanding is arrived as per the repayment schedule stipulated by the bank, right? This you can easily access from the your computer CPS, right? So, or you can manually calculate by the from the sanction letter based on the repayment terms. So here in this example, there is an overdue of 10 lakhs. So how are you going to classify this overdue? So this overdue a term liability or a current liability? So when you see this sort of a balance sheet, in this balance sheet, the term loan outstanding is 100 lakhs. So how are you going to classify this 100 lakhs? A moment to answer this question, and then we'll solve it. So here, please see that. Let us assume what is actually the current liability. The current liability is something that is falling due within the next 1 year. So since the installment is 10 lakhs, so for the next 4 quarters, that is 40 lakhs, this will be the current liability. What is the current liability? That is the amount that is falling due within that's going to fall due within the next 12 months. So in the next 12 months, 4 installments have to be repaid. So current liability will be 40 lakhs. Now term liability, you might be tempted to say total 100 lakhs minus 40 lakhs 60 lakhs, but this is incorrect, right? So you have to see that overdue is also a current liability. In fact, it is the company has not even time left. At least this 40 lakhs has some time. The first 10 lakhs has to be paid by June. The next 10 lakhs is to be paid by September. The third 10 lakhs is to be paid by December. And the final 10 lakhs is to be paid by next year's March. At least they have some time. This June has got 3 months time. This is 6 months time. So there is time. Overdue is something that is already due, right? There is no time. This is 0 days. This is definitely current liability. This can't be term liability. So what is the current liability? It is not just the outstanding. It's not just the installment that is going to fall due within the next 12 months. It's also the overdue, if any. So since 10 lakhs is overdue, so the current liability in this case will be, so it will be modified. It will be, current liability will be 50 lakhs, right? And the term liability will be the balance 50 lakhs. So is this point clear? So whenever there is an overdue, it is also to be classified as current liability. So how should overdues be treated? It should be treated as a current liability. So will the balance sheet give what is the overdue? No, it will not give. See, in the balance sheet, you'll be just given the secured loans, so and so amount, secured loans 100 lakhs. So you won't be given the breakup, how much is current falling due within the next 12 months, how much is falling beyond 12 months, how much is the overdue, you won't be given. So this is up to you as a banker to gather this information. But since you have sanctioned the loan, you'll be having the entire history, the repayment history. You'll be having the sanction letter which stipulates the repayment terms. You'll be knowing the installment. You'll be knowing what is the actual installment, actual outstanding that should be as on the balance sheet date. Then you can see the actual outstanding. Then if the actual outstanding is more than the outstanding which ought to be, then you can say it has some overdues. So this classification is going to be gathered from you from various sources. It is available and it is within your reach because you are the one who has sanctioned the loan. The breakup is usually not given. The overdue is something which is not anyway given. This breakup is sometimes given by some auditors, right? If it is given, well and fine. Otherwise, you have to get it from your own sources. So I think here is a small example which you already discussed. So a loan taken from 10 lakhs. Repayment schedule stipulated by the bank was 5 yearly installments. So 2 lakh each starting from September 2012. So if today's date is 31/3/2012, the next installment is going to fall. This is starting from 39/2012. So 39/2012 will be the first installment, right? And 13, 14, 15, 16. So 5 installments. The repayment, the due date is as follows. This is the due dates. These are the due dates. So from this date, if you are speaking of today's date, 31/3/2012, the first installment is just time left is just 6 months. For the second installment, time left is 1 year 6 months, 2 years 6 months, so on. So what is the current liability? Only this portion, right? The first installment is a current liability. How much? Each installment is 2 lakhs. So 2 lakhs will be a current liability, and the rest 8 lakhs will be term liability, right? So with this we come to the end of this segment. So in the next segment we'll be discussing another item, another term liability, that will be the unsecured loans, right? See you then.